So good afternoon, everyone, and welcome to today's Captive Review virtual symposium on the future of captives. So I'm Lauren Ingram, the editor of Captive Review. So welcome to today's great webinar symposium. Today we're in partnership with the Bermuda Development Agency to bring you this webinar, which I'm very excited about moderating. So just first up, before we start, we've got to do some housekeeping. So as our virtual symposiums are interactive, you have an opportunity to submit some questions to our panelists. So to do this, you just need to go to the website slido.com and enter the code CAPTIVEBDA when prompted. So there'll be a Q&A at the end, so make sure you put your questions in. You can put them in all throughout the webinar, and then they'll be able to come up at the end. As I mentioned, today we're partnering with the BDA, so you know that, and like many of you, I was looking forward to traveling to Bermuda for the Captive Insurance Conference in June until COVID threw the entire year into disarray. But the BDA have been doing some great work online, and I'm really excited to introduce Jasmine De Silva, the Business Development Manager, to talk about everything they've been doing at the moment. So thank you, Jasmine. Oh, Jasmine, you're just still on mute, so we can't hear you.
Oh, my apologies. Good afternoon, everyone, and welcome. Thank you, Lauren, for your kind introduction. The Bermuda Business Development Agency is an independent public-private partnership, and our focus is on promoting the jurisdiction and encouraging economic development and inward direct investment. So I'm delighted to launch this conversation today on captives globally and Bermuda's leading role. The captive insurance industry was born, raised, and perfected in Bermuda, and we continue to build on that history of success as the market grows. We've teamed up with the Captive Review today and brought together some of the jurisdiction's experts to discuss the development of captives as a risk management tool, the fundamental principles that have underpinned Bermuda's development in the captive sector, and how we continue to evolve and innovate in an era of change. So thank you again, and thank you for joining us today as we discuss the future of captives. Lauren?
Thank you so much. So I'm really excited to moderate this panel today. We're going to be talking about the future of captives, so we'll be covering things like the state of the market currently, emerging risks, how regulation plays a role, and what might happen next. So our panelists today are Chiara Nannini, the director at Conyers, Dill and Pearman in Bermuda, Mike Parrish, Senior Vice President and Client Services Leader at Marsh Captive Solutions, and Mark Allett, Managing Director at KPMG. So welcome all. Thank you so much for joining me today. My first question to all of you is kind of what is currently happening when it comes to captives and the market. So Mark, if you want to start off and give us some of your thoughts.
Yeah, thank you, Lauren. So it's actually been a pretty busy time over the course of latter part of last year and into this year. We've seen a significant increase in activity and interest in setting up captives. Largely that's been prompted by the current commercial market terms that are being offered on renewals. Now, it's interesting, we have for a number of years been talking to our captive clients and prospective captive clients about setting up captives or growing the use of their captives. And we've always said that in a soft market is really the time to try and test the business plan and make sure it's viable in all market cycles. It'll only ever get better when the commercial market hardens or terms start to harden. Of course, we have had some uptick in interest and many incorporations during the prolonged soft market that we've experienced. But actually, there's nothing like increased prices to really focus the mind, and that's what we've been seeing over the last few months, where we've had clients really looking at captives, either trying to move forward because of necessity through premium rates, or even just starting to look at captives for the first time, again, because of the renewal terms that are being offered. So it started to get really quite busy. Of course, then COVID-19 hit, and there was a period for a few weeks where there's been a little bit of disruption. I wouldn't necessarily say that nothing's moved ahead in that period of time, but certainly people were wondering quite what to do. Obviously, different business priorities in the parent organizations. However, what I'm heartened by is the fact that actually it's really turned back to business as normal with remote working. So a lot of the projects that we'd been working on and that we were talking to clients about really have continued throughout this process relatively undisturbed. And in fact, actually, there's been a lot of changes as a result of COVID-19. We're seeing clients that are looking at the situation they're faced with in the commercial market around coverage disputes potentially, and actually that's one of the things that's really starting to make people think, actually, this is yet another benefit. It just yet again endorses the benefit that a captive can provide. So that's in just a couple of minutes summary. Really, that's what we're seeing in the current state of the market. What I would say is, of course, there is a lot of competition out there in terms of captive domiciles, but again, we've seen, there's different drivers for different types of structures. I mean, we as a firm, KPMG, we've got offices everywhere. We're unbiased in terms of jurisdiction, but actually we have seen a lot of these structures choose Bermuda for all the same reasons we've seen across history, and of course our access to the reinsurance market is really one of those fundamentals that it comes back to time and time again, where people are having to travel to Bermuda in order to place the reinsurance on the back end of a captive. It makes sense to have it in Bermuda. So yeah, it's an exciting time.
And Mike, do you have any thoughts on this?
Yeah, certainly do. Sorry about that. I had somebody at my front door. Actually delivering a case of wine. Yeah, before we get into the discussion, I wanted to frame it with some statistics about the current state of the market. The statistics come from the Marsh Global Market Index, which is released quarterly and has just come out for the first quarter of 2020. And that index shows that average insurance pricing has risen by 14% in quarter one of 2020. Now that's the 10th consecutive increase and the largest since this index began in 2012. And looking at that from a sort of a line of business perspective, property pricing, that's up by 15% in the quarter. Casualty pricing up by 5%. Financial and professional lines up by 26%. That's just in one quarter. And again, that's global figures. Looking regionally, UK financial and professional lines increased 46% in the first quarter, and 23% for FinPro lines in the US. What I think is interesting and particularly relevant for this discussion is that D&O particularly is very challenging. This index shows that 37% of Marsh's clients faced increased retentions, and some of them faced pricing increases of 100%. So effectively their premium doubled year on year from last year. So I can talk a little bit more about D&O specifically when we go on to talk about captive uses and emerging risks. But generally across the board, that shows that the market at the moment for commercial insurance is challenging, definitely. And historically, what we've seen where markets are challenging in terms of clients having to take higher retentions, double-digit, sometimes triple-digit increases in premiums, lends itself to continued and expanded use of captives, lends itself to self-insurance for companies that already have captives, looking at increasing retentions within their captives. And these are things that we've certainly been seeing over the last few months. So not only are we seeing companies looking at forming captives for specific lines of coverage, but we're also seeing companies with existing captives expanding their uses, looking at putting new lines in due to challenging conditions in the market. So I think it's fair to say that currently, even excluding the COVID situation, the traditional insurance market is challenging, and that's causing companies to look at self-insurance, to look at captives and other vehicles, segregated account companies, sales, as a mechanism for assisting and trying to reduce pricing. And in this current environment that we're going to be seeing for the next, who knows, maybe the next couple of years, maybe even longer, with companies facing very difficult financial conditions, insurance pricing is going to be a big issue for them. And if we can assist them in reducing the cost of insurance by utilising captives and self-insurance more, then I think the captive market is going to play a great role in the economic recovery as we move through this COVID period and into the future.
Yeah, and I think that the point that you made about how, you know, pressures on things like D&O lines have been happening for a really long time, and this isn't just because of COVID. And as Mark said as well, this has been an ongoing trend. So I think that separate to the COVID situation, you know, the interest in captives has been going on for quite a while. Chiara, do you have any points that you want to make now as well?
Nothing, you know, in addition to really what Mark and Mike have said already. I think, you know, I'm at a law firm, obviously, so we assist in the formation and licensing of captive insurers. And, you know, from my perspective, we've certainly seen a continued global interest in establishing our new formations in Bermuda. For 2019, new formations were up from the year before of captives, including in the long-term space, which has grown year over year. So I think I would just echo Mark and Mike's sentiments and just reiterate that, you know, we're seeing that as well in terms of new formations.
Thank you all so much. So, you know, obviously we've been talking about, you know, the current state of the market and things like this, but, you know, captives have always been on the forefront of insurance in many ways. You know, in the cyberspace, for example, captives have been writing policies for many years before other insurers in the traditional market took on some of the lines in that space. What are we seeing when it comes to emerging risks currently and the kind of risks that captives are taking on? Mike, would you like to start?
Yeah, sure. So I talked a little bit about D&O particularly, and you obviously picked up on the fact that the D&O market has been difficult for a while. And you know, D&O traditionally, I would say, is not a line of business that's been used in captives all that much. You know, the D&O market has been very soft for a while, up until the last year or so, maybe a couple of years where it's become difficult. So the D&O is an interesting one to look at, although it's not a new risk and it's not a new and emerging risk. It's something which is relatively new and unused in captives, and maybe for the benefit of you know, of some of the people on this symposium that aren't experts in D&O. D&O is directors and officers, and it covers companies' liability for their directors and officers being sued for their activities as directors and officers of the company. Now, the traditional D&O policy has three different parts, and in insurance parlance, they're known as Side A, Side B, and Side C. So Side A basically covers the directors and officers themselves, where the company can't reimburse them and indemnify them either because they don't want to or they're unable to, because the company's not around anymore, it may have gone bankrupt, or they may be prohibited from indemnifying them in certain circumstances and in certain territories under law. So Side B is the corporate reimbursement side of that, where the company has indemnified a director and then is claiming that money back from their insurance policy. And Side C is basically corporate liability, where the company is sued rather than the individual directors. And usually for public companies, this is only for securities actions and things like that. So these are three different and specific parts of cover. Traditionally, Side A cover has not been used in captives, and there are a number of reasons why. I mean, clearly there is a conflict of interest in a company providing a vehicle for a director and officer to be insured, when it's not allowed to indemnify them in the first place. So a wholly owned subsidiary providing that cover is seen to be somewhat incongruous, and as a director and officer may actually not be acceptable to them. They would rather see obviously something more secure, an insurance policy from a third party provider. We have seen side B and C put into captives, and side B and C cover, although I would say it's not common, I mean, it's certainly something that we've seen in the past, usually used to buy down the deductibles on those covers. What we're seeing now as a new and I suppose an emerging trend is for companies to look at providing side A cover. And it's important to think about how the D&O market works. D&O insurers want to see a lot of financial information from the company. They want to see annual reports, audited financials. They want to see a track record that shows them that this company knows what it's doing and is financially secure. Now, the problem is for many startup companies, and this kind of leads us on to the discussion about new and emerging areas. For startup companies in areas like crypto, cannabis, any new company isn't going to have that track record. And in that sense, it's very difficult for them to buy D&O cover at all. And if they can, it's usually fairly limited and they're faced with very large retentions. So a lot of these companies, rather than using their own captives for D&O side A, are trying to look at using cell facilities such as segregated account companies, PCCs, using the cell, which is actually a third-party vehicle, to provide cover under side A of D&O, and maybe using a captive or another structure for the side B and C, which is a more traditional way of using it and doesn't have the same sort of conflict that that the side A does. Now, the use of a cell with side A also has some drawbacks. It's not a very simple thing to arrange because in most cases you would need to have some sort of trust fund, or the limit would need to be fully collateralized in a form that's acceptable to the directors and officers. So maybe a letter of credit, a collateral, a trust arrangement to hold those funds in the event that there was a claim, and that wouldn't then be at the behest of the company. That would be a third-party arrangement, and the cell, which was owned by a third party, would just pay the loss. So that's a very interesting development, and we've seen it particularly in areas where companies are new, startups, and again, mostly in the crypto and the cannabis areas. And those companies are really struggling to find D&O coverage in the current market, and are looking at captives and cells to meet that need.
Yeah, I think that's really interesting, and I think D&O is going to be a really big have a big part to play. And like you said, I think it's quite interesting how you make the point that it's not really an emerging risk overall, in terms of it's not a new policy in the insurance market, but it is in the captive scene. And I think there's been some big stories that have some big companies that have made the point about their D&O insurance premiums rising. There was a story that came out today about Elon Musk and Tesla saying that they've decided not to renew their traditional insurance for D&O because he said that their premiums were disproportionately high, and so that they were going to go into an alternative risk just to ensure that. It hasn't been confirmed if that's a captive or not, at least not publicly. I don't know if anyone listening, maybe someone knows, but I don't. So I think that is quite interesting that more and more, very well-known and large companies that haven't already looked at captives are. Chiara, do you have anything in this emerging risks area that you want to add?
I think I'll only add that, we've also seen lots of interest in sort of this non-traditional risk area, particularly with crypto and cannabis coming out of Canada in particular. We've had a lot of interest, fielded a lot of questions, and I think this sort of segues nicely maybe into your next question regarding regulation, as obviously, what we've seen already fits nicely into sort of the rules and regulations already set out in Bermuda under the Insurance Act 1978. But there's a lot of sort of new products available, in particular, one of which is the Incorporated Segregated Accounts Companies Act 2019, which sort of provide different strategies to people looking or seeking coverage for non-traditional risk. So I don't know if Mike wanted to add to this before we jump into regulation.
Yeah, Mark, do you have anything to add?
Yeah, sure. I mean, I totally agree with all the comments Mike made around D&O for sure. And I think when we look at the sort of new opportunities and new risks that have been spoken about at a number of conferences over a number of years. Certainly, crypto's always been there. Cannabis has absolutely been there. I think what I would say now is that there's been a development in that. I mean, particularly when you look at Canadian cannabis risk. Or cannabis company risk, it's been spoken about a lot, but there's been relatively little it's taken a long time for that to move towards incorporation. And in fact, it's taken a fair while for the captive jurisdictions themselves to get comfortable with the concept of having captives for those types of industries. But that is now firmly in place, and the interest is absolutely there. We're seeing new incorporations in Bermuda this year for cannabis companies, and that's great to see. I think at the end of the day, any risk that is going to be difficult to model in this current climate is going to be incredibly difficult to place in the commercial market at all at any terms. And of course, the captives insuring what is otherwise uninsurable is a great opportunity. So no, absolutely, I think that's those emerging risks are those by necessity. Certainly, we've seen an increase and a continued increase in interest in trying to leverage captives more in terms of writing additional risks. And employee benefits has been an area that's, I know, been spoken about a lot. I won't go into a huge amount of detail on it on this conversation, but certainly we've seen continued interest in trying to really leverage the existing captive balance sheet to put additional risks into the business, and additional risks that actually start to pull in the human element of the business. So to actually be providing differentiated cover to employees. So that's those emerging risks and the innovation that we're seeing continues to drive in the same direction. I think, as Chiara says, certainly with some of the regulatory changes in Bermuda, I think that fosters more innovation in terms of the type of structure as well as the type of risk, for sure.
Yeah, and as Chiara, as you mentioned, obviously when we're talking about emerging risks and the current state of the market, regulation is very important. So, we start with you, Chiara. What is important when we're looking at regulation and, I guess, structure of captives, both now and into the future with new risks?
Well, I think when you talk about emerging risks, I mean, sort of regulation and structuring. Well, regulation hasn't changed per se. Any captive established will be subject to the rules and regulations that are already in place, and that just sort of shows the flexibility of setting up a Bermuda captive and of the jurisdiction generally. Typically, captives will either be placed in class 1, 2, or 3 for general business captives, or A and B for long-term captives, and they're regulated based on the class of insurance that they hold. And the BMA uses, or the Bermuda Monetary Authority uses, a risk-based approach, and a proportionate approach based on the nature, scale, and complexity of the insurer and its license class. So that really hasn't changed. What we are seeing, though, is the Bermuda government putting forward new legislation and the Bermuda Monetary Authority to encourage innovation and to establish different corporate and other products that can be used in setting up your captive structure. As Mike alluded to earlier, there's always been the ability to set up a captive as a segregated accounts company, so register as a segregated accounts company under the Segregated Accounts Companies Act. And that's used very typically in your rent-a-captive structure, and it allows for a statutory segregation between cells that are established by the segregated accounts company from each other segregated account of the company and the general account of the company. In comparison to that, or I guess as an aside to that, it hasn't actually replaced it. It's just another alternative. We have new legislation that the Bermuda government put out in 2019, the Incorporated Segregated Accounts Companies Act, which, different to a Segregated Accounts Companies Act, each segregated account established by what I'll call the ISAC is a separate legal person. So it has separate legal personality. And therefore that incorporated segregated account can contract with another incorporated segregated account or the ISAC company itself or a third party. So this gives sort of a additional layer of a potential structuring. And it could be, it could be ideal for someone who might be risk averse, who takes comfort from the fact that each incorporated segregated account is a separate legal person. So from a bankruptcy standpoint, or particularly where they're operating in a jurisdiction where segregated accounts aren't something that are recognized. It could also be valuable for an entity that wants to have either a license from the Bermuda Monetary Authority from an ISAC level, or that you could individually license each incorporated segregated account if you wish. Again, that's different from a segregated accounts company. That's currently not possible. Only the segregated accounts company itself can be licensed. It would also allow for things like, for example, one incorporated segregated account could obtain a rating if that was something that was desired, or you could have multiple licensed entities or structures within one ISAC, which is another obviously clear benefit. I don't see that, I think this is very attractive to some, and we have certainly seen a lot of interest with ISACs as well as in the captive space, either new ISACs being incorporated or potentially exploring the ability of a captive insurer to register as an ISAC or to convert from a Segregated Accounts Companies Act to an ISAC. And I think it will ultimately depend on the type of structure that's wanted in the end as to whether or not you choose a segregated accounts company or an ISAC. And I think the other thing worth mentioning is probably the way in which the Bermuda Monetary Authority is promoting innovation. So there is now an ability for captives as well to enter into a sandbox with the Bermuda Monetary Authority. So this allows, for example, insurtech companies that have a specific product or service to enter in the sandbox for a period of about 6 months, with the ultimate aim of exiting the sandbox with a license in a sort of fully transparent manner, and to work with the BMA to sort of, setting up that novel product. And the other thing I'll probably mention, and I would be remiss if I didn't, would be economic substance, which the Economic Substance Act 2018 obviously has been enforced since 31 December 2018. And is, requires any entity in Bermuda or permit company in Bermuda that's carrying on a relevant activity, as that term is defined, as a business, to file a declaration with the Registrar of Companies 6 months after their financial year end. So for 2019, the first filing will be the 30th of June of this year. So that's coming up quite rapidly. In the captive world, insurers will be carrying on the relevant activity of insurance under the Economic Substance Act and related regulations, and therefore will all be required to file a declaration unless they're otherwise tax resident in another jurisdiction. I think typically speaking, we're cognizant of the fact that captives as well as commercial insurers in Bermuda already have substance on island to a large degree. Mainly by virtue of having Bermuda resident board members holding their board meetings in Bermuda, or a majority of those meetings in Bermuda, and outsourcing core income generating activities related to their business of insurance to insurance managers on island. Obviously, the advice is fact specific, but that's generally what we're seeing, which is encouraging, and we're all sort of gearing up for the first filing at the end of June.
Yeah, great. Thank you so much. And Mike or Mark, do you have anything to add to that?
No, I would just add that it's probably worth also commenting on what hasn't been regulated, if you like, and the BMA's approach to the whole COVID crisis and the financial impacts that may have, and you know, I think they've taken a very sensible approach, and we are being asked for a COVID-19 subsequent events disclosure, and we're being asked to provide information on the financial implications of the crisis, not necessarily to the captive, but to the parent company as well. But there has been no regulation, and I have heard some rumours around the place that that the BMA has banned dividends being paid out, or banned intercompany loans, and wants to keep all the liquidity and the money in the captive because they're very nervous about the COVID situation and the financial ramifications. But that's not actually the case. I mean, certainly we are being asked to look fundamentally at liquidity, before we agree dividends, and to look at them with maybe a fresh lens, with the lens of the financial ramifications of COVID on the parent company and on the captive. But to be perfectly honest, that's something that we would do anyway, as a prudent manager, and if we're directors of the company, those are things that we would automatically be looking at. But we are certainly being asked to focus a lot more on that, and to review that, that liquidity before we start declaring dividends and loan backs. But other than that, there is no regulation around that, and I think that's a very good thing, and it still shows that the BMA is flexible and is willing to work with companies, even through a crisis such as this.
Yeah, Mike, I would agree with that. And I think, one of the critical things here with a captive is when a parent, needs the captive has to respond. And I think the ability to allow loan backs or dividends of surplus back to the parent is a critical business issue. And I think if that wasn't possible, I think a parent would have to think seriously about their strategy for a captive going forward. So I think it's absolutely a balancing act. And of course, the BMA need to understand as well, when agreeing those types of distributions, whether, what the claims experience is going to be like on the captive as a result of COVID as well. So the BMA have put out very specific requests in the commercial market, and they are all having to file specific information, as to the impact of COVID. The BSCR will be reflective of the COVID impact as well, as well when they file their solvency self-assessment forms. They'll all have to cover it. So captives are not subject to that level of rigor of regulation, and for good reason. But of course, the BMA does need to be prudent in that regard. The only other area that I was going to mention in terms of regulation is really, I guess, the parallel to the insurance market in Bermuda, where there's been a significant developments around the digital assets business, and the regulation such as the Digital Asset Business Act is attracting, or it's creating new pillars of the Bermuda economy, which is great. What it's actually doing is, what we're seeing is there's a lot of synergies between the types of entities that are setting up in Bermuda, and in fact, some of the crypto-related businesses are setting up captives in Bermuda, and they're choosing Bermuda for all of the right reasons. But in addition to that, because actually it's the place to do business for their core business as well. So it's really that's kind of helped Bermuda in that market, in that sector, for sure.
Yeah, there's been some really interesting things going on in crypto that I've been following, which is really exciting. So as we've been talking about, previously, like even before COVID, the captive market was changing with the hardening market, which was, driving people to look at captives. So, what does the future of captives look like? Which is a very broad question. But I guess if we take it any way you want, in terms of what do you think in a shorter term we're going to be looking at? Mike, if you want to start.
Yeah, sure. What will the future of captives look like? Well, I would like to come up with some real big, innovative, creative idea and say, hey, this is what it's 10 years time. This is what the captive industry is going to look like. I have to be honest and say, the answer to the question, what does the captive future look like? I would have to say it probably looks a lot like the captive past. I've been involved in the captive industry since 1991. When I first put on the pink shorts. And you know, interestingly enough, a couple of weeks ago, I was looking at a captive feasibility study. You know, as one does in lockdown. Some people do jigsaws, but I read captive feasibility studies. And back in the day, I was quite heavily involved in captive promotion, development, and feasibility work. You know, I'm kind of not quite so much involved on that side of things now. But in looking at this captive feasibility study, I mean, sure, the you know, the analytics, the data, you know, the general financial analysis are leagues ahead of what we were doing back in the 90s. But the basic fundamental concept and you know, the qualitative elements of why people should have a captive, really, I could have written that 25 years ago. It really hasn't changed. So the captive industry fundamentally has not changed in that period. And I don't think it's likely to change going forward. So yes, the future of captives is going to look a little bit different because we're going to be covering different risks. Again, you know, using my analogy, 25 years ago, cyber wasn't heard of. Crypto wasn't heard of. Cannabis, well, cannabis was heard of, but I'm not sure we'd have been sitting having a discussion like this in a forum like this about cannabis 25 years ago. Otherwise, we'd have probably been run off to prison. So, you know, the types of things that captives are doing will certainly change. Of course, they have to change as emerging risks come out and companies face different things. But the basic fundamentals of captives, why are we doing this? We're doing it to, you know, to assist with risk management for the parent company, to assist in areas where the traditional market can't assist, maybe to look at rationalization of deductibles in a big group, buying down deductibles, using the financial capacity of the group as a whole to assist business units to carry more risk. All those things are still relevant. So the future of captives, well, the future of captives is still pretty exciting. There's still plenty of things going on. I mean, just give you an example. I've talked a little bit about some of the D&O things we've been doing. Obviously, we have a crypto captive. We're licensing a cannabis captive at the moment. You know, some of the other things we're looking at. I'm doing some work with a company that's a cyber protection company, and they offer a product that yeah, does a cyber risk assessment and also provides a cyber risk management program. Particularly for sort of SME type companies, and now particularly as a lot of people are working from home and the exposure is greatly increased. You know, and they're looking at offering a warranty product that they can provide that says if you use our cyber protection, you know, you won't have a breach. If you have a breach, we'll kind of pay for it. And to do that, they're looking at backing that into a captive type structure. You know, all those things. We're talking to a company about micro life insurance products in South Africa. There are so many different things that you get involved with in the captive industry, and so many different things that come up. It is a very broad question, and it's really difficult to answer because I think the future of captives is really what we make it. And it's very rare that someone comes to me with a question like, well, can I use my captive for this, or can I set up a captive to do this? Very rarely that I can turn around and say no. We can pretty much use a captive in any area which is going to provide a benefit to companies or a benefit to individual policyholders. So you know, I think the future is very bright. I certainly don't see there being a downturn in the captive industry. I think captives still have a role. Captives are very relevant now with the state of the market, probably more relevant than ever. And I think that will continue. And as people find new and emerging risks in their business, then they're going to find new and emerging ways to use their captives.
Yeah, definitely. I think that's a very good point. And like you said, there's lots of exciting things going on. So, Chiara, do you have any thoughts on, I guess, the future of captives?
Well, I totally agree with what Mike said. I mean, it's a broad question. You know, we don't really know, but I think, you know, captives in the future, captive will look like captives today. From my perspective, I think, you know, there's a lot of outside pressures to what we as an offshore jurisdiction do. There are tax pressures, there's economic substance and things of that nature. So the key for me really is, keeping up with what's going on in the outside world and ensuring that we're flexible enough to respond to it, being pragmatic. The Bermuda Monetary Authority as a regulator is very pragmatic, and always trying to be at the cutting edge of new developments and innovation. So I think that's also very important. We have to ensure that we keep up with what's changing out there. And I have seen, there's lots of M&A activity. There's been closures of captives and things of that nature. But on the whole, a lot of that is where, it's not all negative. That there's been closures of smaller captives, but then, a new captive has been set up to take advantage of some new regulation, whether it be a tax regulation or from a Bermuda perspective to, let's say you wanted to set up a ISAC, for example. And we see, larger captives as well. So increased premiums, increased capital, and clients using their captives in a multitude of different ways. So I think things will change because things have to change, because things, that we have no control over will change. But as long as we remain sort of flexible, and, like Mike said, there's always going to be a need for a captive. I think the future's bright.
Yeah, and I think your point about M&A activity is really interesting, because I actually had someone say to me in January at the start of the year, kind of before all of COVID really kicked off in the rest of the world, that they thought it would be a big year for M&A activity anyway. And now I just wonder if that all is to do with the global situation, if that's maybe just pushed it along a bit, or if this was a trend that was already happening. But I think it is really interesting. So, Mark, your thoughts on this very big and kind of impossible question?
Well, I'm not sure how to follow that, actually. No, I think, if I look at the question, which is, the hardening market, what will the future look like? I think it's an interesting phrasing of a question, actually, because we've already spoken about the current market conditions and what that's going to do, and I think the real positives I bring out of that is we've been having a lot of conversations over the last few years with captives and captive owners who have either stopped writing business in their captive because they've decided that actually the commercial market terms are comparable or advantageous to put the risk into, as opposed to their captive, and they've put them into runoff. And we do a lot of captive closures, and each time we're asked to put a captive through a closure process, we always like to test the real rationale for having done that. Often it's too late. The board's already made the decision that it's non-core, and they're not writing business into it. They want to close it. A lot of times that's because actually it stopped writing business a long time ago. The captive was set up by a risk manager that's long since retired, and the current risk manager or the current CFO doesn't really understand the rationale that it was originally set up for. They've never worked in an environment where the captive's been properly used, and therefore it looks like a drain on the group's finances and is trapping capital that could otherwise be directed elsewhere. So a lot of those decisions have been hard and fast decisions, and the captives have been closed down. Certainly now, I think we're in a situation where anybody that had made that decision or is making that decision is generally kind of rethinking it and either putting it on hold or actually reversing that decision and saying, well, actually, everybody else is having to set up a captive because they can't get the right terms in the commercial market. Now's the time to use that captive. So I think it's actually a really good time to be seeing, the existing captive market, reinvigorate the use of their captives. I think that's certainly a benefit that I'm seeing of the current market conditions, and I think that's going to have a legacy into the future, because what we've seen is we've been in a very prolonged market where the commercial terms have been quite reasonable, and I think the legacy of this current market environment is actually going to last a long time. And I think a lot of development of captives and the way captives are used and the way captives are run is actually going to follow a long time after this market cycle and after COVID-19 has hopefully become a distant memory. And I think when we look at what those developments might be, I think in reality, the regulatory tools are there. The structures, the type of regulation, the competition amongst regulatory regimes. It's all there. It's actually created, a really vibrant market, or the openings of a really vibrant market for captives. I think what we're likely to see going forward is, as Mike and Chiara said before, is a lot more innovative use of captives. As Mike said earlier, there's often a lot of what look like weird and wonderful business plans put in front of us, and actually it's hard to say that doesn't work. I mean, yeah, there's things that need to be thought about. There are things that issues that will need to be ironed out. But generally speaking, captives are quite flexible structures, and they can cater to the needs. So I think we're going to see lots more of that. We're going to see lots more different types of risks, different types of structures coming in. And certainly one of the areas that I've been hopeful for a long time, and I'm hoping that this current market state is going to allow, is a bit more of a holistic look of risks across not just a single organization, but groups. And when I say groups, I'm looking at even things like private equity funds, where they have portfolio companies, where generally speaking, they allow each portfolio company to have a fair amount of their own freedom around their insurance placement. I'm hopeful that actually the benefits in captives will be seen on a company by company basis. They'll see that it is a current and sexy thing to be having in a group. And actually what we'll find is that the people will be more open to exploring what actually benefits can be harnessed across group entities. That's not necessarily to say that trade associations and group captives will see a resurgence, although they may do, but certainly I think larger groups will be looking at them more holistically than before. I also think they'll develop a little bit more technology around it. Captives are efficient vehicles. They're certainly efficient, and we would always say they're efficient versus the commercial market when they're writing the particular parent's risk. They're not having to pay a share of the administration costs of the commercial insurer. They're not having to pay for the marketing and business development costs of a commercial insurer. But actually, I think there are things that can be done around the edges to just increase the efficiency of the way a captive operates. There have been discussions around the use of different technologies to achieve that, and I think we're going to see more and more of that, particularly as captives are used more broadly by more cutting edge technology firms.
Yeah, that's some really interesting points. And look, I think we've had a really great discussion, but we have so many questions that have come in. So obviously you've all been, as I suspected, very, very interesting. So we're going to move on to Q&A now. And so we've got lots of questions coming in. I'm going to kind of pick some to start with. Look, we did kind of focus on this a little bit, and I think I just want to see if there's anything else you want to add, because I think obviously it's a very popular topic. We've got a question in here. Are you seeing a growth in cannabis risks in captives where generally is the parent based, and what lines of business? So we did kind of cover some of this, but Mark, do you want to start, since you were speaking a little bit about this?
Yeah, sure. And I know that we're currently working on an entity that's being going through the licensing process at the moment with Mike, actually. So absolutely, we are seeing we're seeing new captives, to ensure the risks of cannabis producers. Those generally are coming from Canada, and there's a number of reasons for that. But Canadian companies are certainly the first to move. There are issues obviously in the US in terms of state-by-state regulation as opposed to federal regulation, which causes quite considerable barriers to some of those entities setting up captives. And also there's some banking challenges as well. We are seeing interest from the US as well, though. I mean, we've had discussions with cannabis dispensaries, where they've had to put in place sufficient, procedures and capacity to kind of deal with their stock if a situation of a breach of the regulations occurred. So there are certain sort of almost ancillary risks coming out of the US, but certainly where we're seeing the vast majority of the activities in Canada at the moment.
Mike, is there anything you want to add?
No, I think that was a very good summary. In terms of the US and Canada issue, I mean, really, the issue there is a BMA one. In that the BMA's guidance was very clear that they weren't prepared to give an insurance license to a company in a territory where what they were doing wasn't legal at the federal level. In the US, there are several states, many states, where the use of recreational cannabis and medicinal cannabis is legal, but at the federal level, it is still illegal. And that's a barrier for Bermuda, because Bermuda cannot issue insurance policies that are considered illegal federally in the US. So the real distinction there is that in Canada, it is a legal industry at the federal level. And that's why most of the interest that we're seeing and those that are developed further have been from Canada, because there it's legal, and the BMA has made it very clear that they welcome that business, and they are prepared to look at it. But it is a problem from the US for that state federal issue that Mark alluded to.
So we do have a question here that has quite a lot of likes, so I think we'll move on to that one next. I think it's quite popular given the current worldwide situation, but do you see a captive covering pandemic or endemic type risks in the future? Would it make sense? So Michael, Mark, or do you have any thoughts on this?
Yeah, well, the answer to the question is yes, quite possibly. In fact, we do have some captives at the moment that do have business interruption as a result of contagious disease cover, specifically within the captive. So yes, the answer to the question is there is certainly a possibility for captives to cover that. But again, the main issue is really the amount of cover that can be provided. This is an absolutely catastrophic situation, and we're expecting $500 million in cover, for instance. You're not going to find a captive that's going to provide that. If you're looking at fairly limited levels of cover, either as a correspondent to a traditional market placement that may have some exclusions that you want to broaden and have cover in the captive, or as a lower level, as a primary layer, and buy excess cover above that, if it's possible, then yes, I can see that. But it certainly is an area where obviously we've had a number of inquiries. We are looking at it. There are products on the market, and there are also products that look at modelling these kinds of risks and provide some risk transfer on the back of that. So a captive can fit quite well in that, but again, with the caveat that you've got to remember the limit that the captive is going to be able to provide, and for some companies that are facing business interruption losses for being closed down for 2-3 months, then the kind of limits that a captive may be able to provide would probably be a drop in the ocean. But certainly, I mean, the answer to the question is yes, we do have a couple of captives that do that already, and it certainly could be an area where captives could become involved in the future.
Now I'm going to try and get through some of these questions quickly, so I'll move on to another one, which said, in today's Financial Times, Lloyd's of London predicts a historically bad year for insurers, primarily due to COVID-19, which will come at a cost to the sector of $203 billion. Just over half of that $203 billion will come from claims. How badly does the panel think that the Bermuda captive industry will be affected? Is this an opportunity for Bermuda? So I guess obviously in some parts of the world, COVID is impacting quite badly. So how do we think it's going to impact Bermuda? So Chiara, do you have any thoughts?
I think I'll probably let Mark take this one.
Oh yeah, no worries. Mark?
Yeah, sure. I think when you look at the losses that are being predicted in the commercial market, they're significant numbers. We've certainly seen in the press, certain insurers being having, I guess, getting a bit of heat for some of the positions they're taking in relation, particularly to BI claims. I think when I look at how that's going to impact the captive industry, I think what it's going to do is absolutely captives are going to have an increased claims experience, and that is to a certain extent because there's more flexibility in terms of the captive providing coverage, and there's flexibility in both the way that the program was designed and the terms and conditions of the policies that were written, but also particularly in a pure captive environment where it's a single parent captive. At the end of the day, the captive holds a pot of assets that need to be released, and there is the opportunity for where there's subjectivity around coverage. It's not going to get into a dispute situation. The group is going to resolve it, and they'll resolve it in the way that has the best impact to the group. So I think we'll certainly see captives with an increased claims experience. I think that's important that we do see that, in fact, as well, because it does justify and is a testament to how the captive can react in an event like this. I think longer term, it goes back to the comments we were talking about earlier, which is to say that I actually feel that where there's a lot of disgruntlement by insureds in the current climate where they bought policies that they had assumed had cover, and in reality, actually, pandemic risk was excluded, or particular viruses were excluded, or at least specific viruses were included, by which obviously COVID-19 was not one of those specific viruses being new. So I think there's going to be a little bit of of a legacy to that, which says, well, look, we don't, there's going to be a little bit more of a distrust in terms of the commercial terms that are being offered to them, and they are going to look, as Mike says, to try and complement any commercial market cover into their captive. Or potentially, seek cover if they don't believe that it is covered at all, or they can't get coverage on commercial terms. Then they'll they can resort to their captive, which is, So I actually, over time, I think it both proves the concept of captives to have claims, and it also proves the concept of captives to provide capacity going forward.
Yeah, I think that's a really interesting point. So unfortunately, I think we're running out of time. So even though we have many, many questions here, we're not going to be able to get to all of them, unfortunately. So I want to thank everyone for being on the panel. And we've got Jasmine back, who's going to say a few words before we go. So thank you so much, Jasmine.
No, thank you, Lauren, and thank you to Kiara and Mike and Mark. You're very much appreciated. This was a great discussion. It was very informative. And if anyone there are many questions, so if anyone still would like to get answers to those questions, please do not hesitate to contact myself so that we can have a follow-up discussion and continue this discussion. I encourage everyone to stay up to date with the Bermuda developments in the market and follow us on bda.bm, sign up for our newsletter, so you can get informed on what's going on in the jurisdiction and have direct access to all of the experts that we have on island. So thank you again to our panelists and also to yourself, Lauren.
Thank you so much. So I just want to thank everyone for tuning in. So just a reminder, we have launched now our virtual US Captive Summit, which is going to be a kind of half-day online event aimed at captive owners. So Thursday, July 9th, and please get in touch if you're interested in attending. The website is captivesummitus.com. We also have our next virtual symposium, which is on next Tuesday, on risk financing. So if you're interested in that, please register and tune in. And thank you again so much to everyone. This was a really great discussion, and I think it was very interesting. So have a great day, and I hope to see you all next time.
Thank you.